Nick sits at his desk, illuminated by the harsh glow of his computer screen. He stares at the total tax line on his 1040 tax form, anxiety visible on his face. A pit forms in Nick's stomach as he contemplates the amount owed. Nick mentally calculates how many months of work went just to pay taxes. He imagines vacations he didn't take, feeling a sense of loss. Nick thinks about the business upgrades he couldn't afford. He remembers the extra money he wanted to save for his kids' education. All these dreams and plans feel out of reach, replaced by frustration. Nick scrolls through Instagram and sees a finance guru boasting about how the rich don't pay taxes. Anger and disbelief cross Nick's face as he watches the video. He feels tempted to throw his laptop in frustration. Nick reflects on his efforts, working hard, tracking receipts, using QuickBooks. Despite doing everything right, Nick feels punished by the tax system. He recalls common misconceptions about tax strategy and shady loopholes. Nick realizes most people miss out on savings simply because they don't know the rules. A light bulb moment. Nick wonders if there's a legal way to save on taxes. Nick introduces the idea of taking $15,000 out of a business tax-free. He reassures the audience that it's not a scam or money laundering. Nick reveals the secret, Section 280A, also known as the Augusta Rule. He promises to explain how it works, the math behind it, and the mindset needed. Nick introduces himself, passionate about understanding the invisible scripts of finance. He invites viewers to subscribe and like the video for more insights. Nick explains the complexity of the tax code, emphasizing its length and difficulty. He calculates how long it would take to read the entire tax code. Nick points out that most people rely on CPAs to interpret the rules. He criticizes CPAs for being historians who only report what happened, not what could be done. Nick vows to change the narrative and empower viewers with knowledge. He introduces the Augusta Rule as a rare IRS get-out-of-jail-free card. Nick claims that most small business owners aren't using this opportunity. He sets the stage to explain the origins of the Augusta Rule. Nick recounts the story of Augusta, Georgia in the 1970s. Residents face an influx of wealthy tourists during the Masters golf tournament. Locals see an opportunity to rent out their homes for large sums of money. They worry about paying taxes on this rental income. The residents organize and lobby for a tax exemption. Surprisingly, the IRS creates Section 280AG in response. The rule allows homeowners to rent their homes for up to 14 days tax-free. Nick emphasizes that this income is non-reportable. He anticipates skepticism from viewers who don't live in Georgia. Nick explains that the rule applies nationwide, not just in Augusta. He reveals that the IRS doesn't specify who must rent the home. Nick explains that business owners can rent their own homes to their businesses. He clarifies that S-Corps, C-Corps, and some LLCs qualify. Nick points out that the business is a separate legal entity. He describes how the business can rent the home for meetings. Nick pauses to acknowledge viewers' doubts about legality. He addresses the fear of triggering an audit. Nick explains that legality doesn't always mean obviousness. He discusses how the tax code is designed as a system of incentives. Nick highlights the government's goals: homeownership and business growth. He frames the Augusta Rule as a natural incentive, not a loophole. Nick cites a study showing most small business owners overpay taxes. He quantifies the average overpayment as $3,000 to $11,000 per year. Nick equates $11,000 to a used car or a year of IRA contributions. He calls this overpayment the ignorance tax. Nick urges viewers not to assume the IRS is out to get them for following the rules. The narrator introduces the concept of showing the actual math behind a tax strategy. A successful business owner is described, making $150,000 a year in profit and in the 24% federal tax bracket. The business owner typically holds monthly board meetings or strategy sessions. Instead of renting a conference room at a Marriott for $500 or meeting in a noisy Starbucks, the owner considers hosting meetings at home. The owner researches the market rate for meeting spaces, finding that a high-end local rental or hotel boardroom costs $1,000 a day. The owner decides to rent their home to their business for 14 days a year at $1,000 a day. The business writes a check for $14,000 to the owner personally as a rent expense. The business records the $14,000 as a rent expense, reducing its taxable income. The owner receives $14,000 in their personal bank account. Because of Section 280A, the $14,000 is tax-free and does not need to be reported on the tax return. A comparison is made. If the $14,000 had stayed in the business as profit, the owner would have paid 24% in federal taxes. The calculation shows that 24% of $14,000 is $3,360 in taxes. An additional state income tax savings is considered estimated at 6%, which is $840. Total tax savings from this strategy are calculated to be $4,200. The narrator emphasizes that this $4,200 is essentially a raise for the business owner, achieved by changing the meeting location and proper documentation. The narrator reiterates the power of the math of optimization. The narrator addresses skepticism about charging $1,000 a day for a house rental. It is explained that a house offers more than just a room, privacy, security, high-speed internet, multiple rooms, a kitchen, and AV equipment. Comparison is made to renting a suite at the Four Seasons for a 10-person meeting, which would cost even more than $1,000. The concept of reasonableness is introduced. The rate must fit the location and quality of the home. Examples are given. A one-bedroom apartment in rural Kansas can't charge $3,000 a day, but $500 to $1,200 is reasonable in suburban areas. The narrative shifts to the psychology of taxes, introducing the idea of the IRS boogeyman. Nick addresses the audience's fear of being audited and the feeling that this strategy is cheating adjacent. Nick discusses the psychology of money and how people view taxes as a fixed cost. The IRS is described as an omniscient, vengeful entity in people's minds, leading to tax trauma. Nick explains the reality. The IRS is a large, underfunded bureaucracy that operates logically. The IRS is not targeting people who follow Section 280A, but those who lie on their taxes. A distinction is made between tax evasion illegal and tax avoidance legal. Tax evasion is defined as lying about income. Tax avoidance is defined as using the tax code to one's advantage. A quote from Judge Learned Hand is introduced. People are not obligated to pay more taxes than necessary. The quote is emphasized. There is no patriotic duty to pay extra taxes. Nick addresses the feeling of guilt associated with using the Augusta Rule. He explains that renting your house to a film crew for 14 days would not feel guilty, so renting to your own company should not either. The reason for guilt is explored. Difficulty in seeing oneself as both employer and employee. Nick describes the worker bee mindset where people believe they only deserve what is left over. He encourages shifting to the architect mindset, where one designs their own financial system. The narrator concludes by empowering the audience to take control of their finances. The business owner is shown feeling empowered after understanding the math and psychology. The owner confidently hosts a board meeting at home, documenting the process. The owner writes a check from the business to themselves for rent. The owner files taxes, properly documenting the rent expense and tax-free income. The owner reflects on the $4,200 saved and feels proud of optimizing their finances. A visual comparison is shown between hosting meetings at home versus renting expensive hotel spaces. The owner enjoys the comfort and convenience of hosting meetings in their own home. Colleagues or board members appreciate the upgraded meeting environment. Owner reviews the tax code, feeling reassured about the legality of the strategy. The owner shares the strategy with other business owners, spreading financial empowerment. The narrative ends with a call to action, encouraging others to become the architect of their financial systems. Nick addresses the audience, emphasizing that you can't just Venmo yourself $14,000 and write Augusta in the memo. Nick explains the need for professionalism in treating the process like a contract with a third party. Nick expresses frustration at oversimplified TikTok advice that skips important details. Nick introduces Step 1, the corporate meeting. Nick explains the need for a legitimate business purpose for the meeting. Nick lists examples of legitimate meetings: monthly strategy session, board of directors meeting, year-end review. Nick holds up a piece of paper to represent meeting minutes. Nick describes what meeting minutes should include: attendees, topics discussed, start and end times. Nick warns that, without minutes, the meeting doesn't exist in the eyes of the IRS. Nick introduces Step 2, the fair market value FMV. Nick explains the need for proof that the price charged is reasonable. Nick suggests going to a local hotel to ask for a conference room. Quote, Nick recommends checking Peerspace or Liquid Space for comparable rental prices. Nick advises printing or saving these quotes as PDFs for documentation. Nick explains that these comps can justify the rental price to the IRS. Nick introduces Step 3, the rental agreement. Nick explains the importance of a simple, one-page rental agreement between you and your business. Nick emphasizes that this agreement establishes the legal framework. Nick introduces Step 4, the paper trail. Nick explains that the business must actually pay you, not just move money around. Nick instructs to write a check from the business account to the personal account and deposit it. Nick introduces Step 5, the 14-day limit. Nick warns that exceeding 14 days makes the entire amount taxable. Nick uses a Cinderella analogy. After 14 days, the tax benefit disappears. Nick clarifies that the 14 days do not have to be consecutive. Nick gives examples. 1 day a month for strategy sessions, 2 days for annual planning. Nick presents a relatable analogy, comparing standard deductions to rain and the Augusta Rule to an irrigation system. Nick explains that the Augusta Rule is about using resources you already have. Nick transitions to addressing common objections from viewers. Nick reads a question. Can I do both the Augusta Rule and the home office deduction? Nick explains the difference between the home office deduction and the Augusta Rule. Nick clarifies that the home office deduction is for exclusive use, while the Augusta Rule is for renting the entire residence or common areas. Nick addresses another question. I'm a sole proprietor. Can I do this? Nick explains that sole proprietors can't rent to themselves, but S-Corps and C-Corps can. Nick highlights the benefits of switching to an S-Corp at a certain profit level. Nick addresses the concern. Is this a red flag? Nick cites IRS audit rates and explains that audits are usually just requests for documentation. Nick reassures that proper documentation removes risk. Nick expresses frustration that people spend more time researching TVs than doing tax paperwork. Nick emphasizes the value of tax savings compared to earned revenue. Nick explains that saving $1 in taxes is worth more than earning $1 in revenue. Nick calls tax savings the highest margin revenue a business can have. Nick transitions to the revelation, scaling the strategy. Nick explains that the Augusta Rule can be used for company events if you have employees. Nick gives examples. Company Christmas party, summer BBQ, renting your backyard or bottom floor. Nick compares the cost of renting your home to renting a park pavilion or restaurant room. Nick explains that the business pays you, employees enjoy the event, and you get a tax-free reimbursement. Nick suggests hosting masterminds or VIP days at home instead of co-working spaces. Nick encourages viewers to see their home as a strategic asset, not just a liability. Nick explains that the wealthy use systems to turn lifestyle expenses into deductions. Nick cautions against greed and exaggerating rental values. Nick warns that the IRS uses a smell test to detect unreasonable claims. Nick gives an example of someone trying to deduct their wedding as a marketing event. Nick transitions to actionable steps and motivation. Nick challenges viewers to take action instead of just watching. Nick presents a 3-step action plan. Calendar check, evidence file, template. Nick explains the calendar check. Schedule 14 strategy and planning days for the year. Nick describes the evidence file. Collect screenshots of meeting room prices and save them. Nick explains the template. Create a meeting minutes template with date, attendees, agenda, and action items. Nick emphasizes that these small steps add up to significant wealth over time. Nick calculates the long-term value. $4,000 a year invested for 20 years grows to $229,000. Nick asks if the strategy still feels too small to matter. Nick explains that the system is confusing to discourage people from using it. Nick encourages viewers not to be most people and to take advantage of the rules. Nick urges viewers to take the deduction, save the money, and invest the difference. Nick promotes his playlist on the psychology of wealth for further learning. Nick concludes by reminding viewers that math doesn't lie, but stories about money often do. Nick signs off, promising to see viewers in the next video.